Thank you for joining me for our tax seminar recap regarding 2020 tax changes and planning strategies. During our presentation, we covered tax bracket changes for 2020, key provisions of the CARES Act implemented in March 2020, and key provisions of the Secure Act implemented during 2029. We'll look ahead for 2021 and beyond to uncover some tax planning strategies, including Roth conversions and keeping an eye on Medicare premium adjustments. We'll close with general tax planning strategies and a checklist. As you look to 2020, you'll see some slight changes in the marginal tax brackets. You'll also notice some color coding that we have: green, yellow, red. Remember these color codings because each one sort of allows you to strategize on whether you should add income or increase your deductions. We'll cover a little bit more of this later. The 2020 standard deduction has increased slightly from 2019. We need to be aware of where our standard deduction is so that we can strategize itemizing or standard deduction in any given tax year. The CARES Act was the largest stimulus relief package put in place in the United States history. It was to provide immediate response to the COVID-19 pandemic and help stimulate the economy. One of the key features was economic impact payments. It was $1,200 for single individuals and $2,400 for married couples, capped at certain income limits. There was also a provision for $500 for each qualifying child. There was a phase out of the economic impact payments, and if you did not receive your payment, there may be an opportunity when you file your 2020 tax return as the credit will be reconciled. Charitable contributions. There were some changes regarding charitable contributions. One thing most people aren't aware of is that you can take a $300 above the line deduction for cash contributions in 2020. This is only for 2020 and not available for later years. There's also a limitation increase from the adjusted gross income limits from 60% to 100%. So in the past, if your adjusted gross income was $100,000, you could only deduct up to $60,000 of charitable contributions. Now that cap is 100% of your adjusted gross income, or in this case, $100,000. Also a key feature was required minimum distributions have been waived. So if you've not taken your required minimum distribution for 2020, don't worry about it. It's waived and it's a tax saving measure. You can still take the distribution if you desire, but it's not necessary. The Secure Act is not just a one-year plug like the CARES Act. It's an ongoing legislation change that impacts planning strategies and tax decisions going forward. So the age for required minimum distributions has been changed from 70 and a half to age 72. So it's something to think about when you're nearing required minimum distribution age. How should you take your distributions out? Contributing to an IRA. Previously, when you reached 70 and a half, you were no longer able to contribute to a traditional IRA. But now with the Secure Act, as long as you have earned income, you can contribute to your IRA. This is a tax-saving thing for individuals as they age. If they still have income, they can still contribute and get a deduction for it. Roth IRAs have never had an age limitation. You just had to satisfy earned income rules. Inherited IRAs. Previously, if you inherited an IRA, you could take the distributions out over the beneficiary's lifetime. Now they've capped this to a 10-year rule, but only under certain circumstances can you distribute over a longer period of time. For instance, if you're a spouse, you can still claim it as your own IRA and take distributions out over your lifetime. If you're a minor child, there are certain rules set in place. Or if you're disabled, there's some certain circumstances there to stretch the distributions, or if you're a beneficiary younger than 10 years, within 10 years of the deceased. IRA charitable distributions have not changed, but something I wanted to point out. Previously, when you reached your RMD age at 70 and a half, you were able to take what's called a qualified charitable distribution. It's moving money from your IRA to your charity. But now RMD age is at 72. But you can still start your IRA to charity at 70 and a half. It is capped at $100,000 per year, and it's a great tax planning strategy to avoid taxation on your IRA distributions. As you may recall from one of the earlier slides when we were looking at our marginal tax brackets, we had color coding for the different brackets. The green sort of symbolizes an opportunity to increase income. And the rationale behind that is that the 10 and the 12% marginal tax bracket are historically low brackets. So when you're in these low brackets, you might want to consider things like Roth conversion, capital gain harvesting, because in these two brackets, capital gains are taxed at 0% long-term rates. And also you might want to consider deferring itemized deductions. When you're in the middle brackets, the 22 or the 24%, it's like a yellow light. You either can speed up or slow down. It's sort of up to you. But some great strategies would be to fund your 401k, your IRA, or your HSA. Think about selling some assets that may be at a loss to offset some of your other capital gains. And bunch your deductions, like putting 2 years worth of itemized deductions in 1 year. When you're in the highest tax bracket, this is where we want to slow up, red light. We want to stop adding extra income because we're taxed at such a high rate. So things that you might consider would be sending money from your IRA to your favorite charity, consider donating appreciated stock to a donor-advised fund, or just moving money out of your estate by gifting to family members. You can also consider things like defined benefit plans or cash balance pension plans that allow you to superfund these retirement accounts. One great planning strategy for this year is the Roth IRA conversion. Why it was so important in 2020 was that the RMD requirement has been waived. Many people that chose not to take their IRA distribution realized that they had really low income, so it put them in the 10 or the 12% marginal tax bracket. This is a great year to move money out of your IRA to your Roth IRA and take advantage of really low rates. One thing to consider is if you have basis in your traditional IRA, it may be favorable to convert to a Roth IRA because you won't be paying tax on 100% of the conversion. There are no income limits to Roth conversions, but you first must take your IRA required minimum distribution, and then you can convert. Medicare planning. As we all know, there is an income-related monthly adjustment amount. So we want to be aware of how our Medicare Part B and Part D premiums may change as our income bracket changes. We don't want to be penny wise and pound foolish by having a great tax planning strategy, but that puts us into a higher Medicare adjustment bracket. So be mindful of this when you're thinking through your tax planning strategies. This general checklist is a great tool to use and to keep with you and consult with your advisor for various topics. So for retirement planning, are you funding your IRAs, your 401ks, or other qualified accounts? Make sure you're optimizing your traditional IRAs versus your Roth IRAs. Which ones would be better given your tax bracket? Have you thought about a Roth conversion? And what about your annual required minimum distribution? Is there an opportunity to give to your favorite charity and save some taxes? Education planning. Don't forget about your children or grandchildren. There are ways to make tax advantage decisions to grow these funds and get tax-free withdrawals. Medical expenses. HSAs are a great tool to put into if you can, so explore that opportunity if available. Charitable planning. Consider qualified charitable donations from an IRA. A great strategy and it's super easy to do. Consider gifting long-term appreciated assets, either to a donor-advised fund or to individuals that may be at a lower tax bracket. Estate planning. Make annual gifts up to the $15,000 per individual if available. Consider paying a loved one's medical bill or making a tuition payment directly to the institution. Also, think through significant life events that may happen. Is there new money in your life? Do you need to consider some new investments? What about investment reallocation plans? Does that cause any taxes that you might need to be aware of? Do you have stock options with your company that are vesting? There's definitely a planning strategy regarding the best option strategies. And disposition of rental properties. If you sold your rental property, there may be passive losses previously that you were unable to deduct. Now you may be able to deduct them and take advantage of some tax savings. Consider major life events, whether they're family changes, job changes, retiring, or moving. When we think through tax planning, we want to basically manage our tax bracket. It's optimizing the rates today. If we have lower rates today, we want to make sure that we're taking advantage of the low rates, because if we expect higher rates in the future, there's things we want to make sure we do. Thank you for joining me in this recap. Please give our firm a call and touch base with us if you have any additional questions. We'd love to help you through any of these checklist items, help you think through your taxes, and to optimize your strategy going forward. Thank you very much and have a great day.